am Laura Harbison, broker-owner of Realty Executive Southern Nevada Properties, and this is Real Estate Today. I am here with Matt Hennessy of Benchmark Mortgage, and we're going to have a discussion today about when it would make sense to let go of that low mortgage interest rate that you may have on your property right now.
Laura, we've had a lot of these conversations.
Yes.
Pretty much over the last couple of years when we helped hundreds of our families secure a very low interest rate, and we're proud of that. Yet, unfortunately, with perhaps some life changes, there's been opportunities for discussions of when would I ever part with that low interest rate? And maybe we have to do just a little bit of a step back to the point of, if we remember during the last 4 or 5 years, and then specifically during COVID, when we saw, housing have this frenzy, low interest rates, high demand for housing, and we found ourselves, having clients and consumers kind of step outside their comfort zone, right? You've witnessed losing out on an offer, and sometimes they, after numerous offers, finally are able to obtain their home. So fast forward to today, the conversations really surround for me is, Matt, I have this really low interest rate. When would it make sense to ever part with that? And we always want to take a more of a holistic approach to it, because if I have a very low interest rate on my mortgage, that's really not the big picture. The bigger picture is, Mr. and Mrs. Client, let's take a look at your overall finances, because, a good mortgage advisor really is looking at their debt. Just like a stockbroker would look over your assets, we're going to look at your liabilities. And when we talk about overall debt, it's not uncommon when we look at someone's credit, and this is, which I think everybody out there realizes that, everybody uses credit a little bit differently. So I might have clients that, Matt, I never used credit. I paid off every single month. Or because of the last couple of years, I kind of went on this period of time where I started charging up more on my credit cards. And let's face it,
credit card debt is at a historical high in the United States. And I think a lot of people got buried in it. The interest rates are so high that they've been stuck on that treadmill.
Without a doubt. And what we've noticed is, I was analyzing the majority of our clients' credit reports, is they're very often just barely making the minimum payment. And, if we thank, the government for one intervention in regards to what we see is, the fact that they have to tell us, Matt, if you take out this much money on a credit card, this is your interest rate, and this is how long it would take to pay off that credit card if you made just the minimum payments. So it's not uncommon for us to see individuals who have a very low rate, let's call it in the threes, yet, they have revolving credit card debt of, let's call it $15,000, $20,000, $30,000 sometimes. And let's face it, we saw inflation, we saw the Fed funds rate rise many times over the last couple of years. And so it's not uncommon to see the average credit card interest rate in the high 20s.
Oh, or more.
So, sometimes when somebody says, Matt, but I have this really low interest rate on my mortgage, but then I have to point out, yes, if we're being honest, you also have, thousands of dollars in credit card debt that if you take into account a blended interest rate, which is the amount that I owe, the higher interest rates compared to even that very low interest rate on your mortgage, your blended interest rate is sometimes in the 6 and 7% range, where, again, it's not my intent to tell clients and everybody that I speak with is, oh, you need to do something with that. I think we could be honest and say the conversations around the dinner table always surround, if we're really looking in the mirror, I've ran up my debt a little bit, I need a little bit of help, and I'm just embarrassed sometimes to raise my hand. I'm sure you have conversations like that.
Oh, all the time. And looking at the difference in, your mortgage interest is pre-tax versus your, it's good. Yeah, exactly. It's a deductible versus all that credit card debt that they're paying, all that interest. It's just money in the garbage.
Correct. And I think many times when we look at this in a bigger picture is like, what options are available to them? Now, there are some of our clients who what we know are very disciplined. They could do this on their own. They could look at their credit and say, hey, I could theoretically take into account what we call the snowball debt method, which is I list out all my minimum debt. So every credit card that I have, every revolving credit card, and I literally tackle the one that's the smallest, irregardless of the interest rate. Tackle the smallest one, because here we are writing this or putting this together here in February. I'll be honest, most individuals quit the gym, right, after a New Year's resolution, after the mid-February. And that's only because when we talk about, going along this path, I'm more likely, and this is what I've seen, to give up if I don't see some type of momentum. And I like this snowball debt method for one reason. Gives them the opportunity to pay down debt, and they can see incremental balances. improve over time. Yet as opposed to the avalanche method, most financial advisors would say, hey, tackle the one that has the highest interest rate. You and I both know if I tackle the highest interest rate, I'm not making the most dent, right? So unfortunately, I might save more money and the financial advisor says, good job, but I might give up so quickly, like I am, a couple weeks into the year, not going to the gym. So I like those conversations first. You could address the debt in the conversation behind the scenes, as opposed to, again, path number 2 is we are all on the same page. You have a conversation with the client, say, anything holding you back? Well, what's the bigger picture in your life right now? Maybe I want an opportunity to move up. We have a growing family. You know what? We're actually going to downsize. I'm an empty nester per se. And at that point in time, this is the conversation we would have as a strategy. And I think the strategy goes with finances is we're always, inclined to, address home affordability. When you sell a house and you tell the client, okay, you're going to net this much money, and now we apply that toward the new purchase, yes, our goal is to have a very comfortable mortgage payment for you. But is that the most advisable when I have $40,000, $50,000 in negative debt? And I might want to apply that, get rid of that ugly debt, free up some cash flow, and still have a better outcome as you look to helping them in that next transaction.
Right, and that doesn't have to just be credit cards. That could be car payments. That could
Student
be
loans, yeah.
Student loans, absolutely. I mean, there's all types of non-deductible interest debts.
How often do you hear conversations surrounding, I'd like to move, but? Do you have
Constantly.
situations? Okay.
Constantly. And that's when I help them talk to you,
Yeah.
so they can look at the bigger picture.
And we know everybody has a unique situation, so this doesn't apply to everyone.
Right.
But I guarantee as you have more conversations with family and friends, they might like the house, but they don't love it. And and if I'm being candid, I think you and I have had
A
conversations
lot
where
of people settled.
they settled, yeah, which is unfortunate.
Yeah.
And now they have a roof over their head, and we could say, I'm glad we did that for one reason. Look at the appreciation. Look how much wealth you've created in real estate. But unfortunately, if you're looking in the mirror, or during COVID, you probably saw, your backyard, you're spending a lot of time at home, and you're like, I like the house, I don't love it. And this may be an opportunity for us just to have deeper conversations of, can I right this ship, go on a different path, maybe do a 1-2 punch, which is when I sell that property, now there are opportunities to get rid of the debt that I have, and then circle back and get into a potential, larger house, smaller house, whatever it may be.
Right. Maybe they got the 2-story, but they really regret it and need the 1-story, or they need one more bedroom, or what have you. So,
and I would probably say is, if any of our listeners or viewers have any questions about paying down debt as opposed to making any real estate transactions, I think it's a good opportunity for us just to have a good conversation first, in depth, review everything, and then give perhaps some guidelines of, if you could do this on your own, great. Here's a little bit of a game plan going forward. And if you have a combination of that sounds great, but I was also thinking about making a move, this is a great opportunity for us to circle back and just provide some guidance.
Look at the bigger picture. Help you out. Okay, very good. Yeah.
That's all I had today.
Yeah, so very good. So thank you for tuning in to Real Estate Today. I'm Laura Harbison, broker owner of Realty Executive Southern Nevada Properties, and your host. And this has been Matt Hennessy with Benchmark Mortgage, here to share all his knowledge with us. And if you have questions, please contact us. You can see below. My phone number is 702-777-1234. You can see our website below as well. And feel free to give us a call, and we'll answer any questions that you have. We're looking forward to hearing from you.
Thank you.